The Orange County housing market is shifting, finally. Inventory is dropping, buyer demand is climbing, mortgage rates are moving, and there's a lot of noise about foreclosures. But here's the truth. Today's market looks nothing like 2008, and the biggest factor to watch right now isn't foreclosures, it's jobs and interest rates. I'm Tim Smith, principal of the Tim Smith Real Estate Group, Coldwell Banker Realty's #1 team in California. Let's dive into your October 2025 Orange County real estate market update. There's speculation that slowing job growth and affordability challenges could trigger a foreclosure wave like the Great Recession. Not gonna happen, but the data tells a very different story. Back in 2008, risky loans and weak lending standards led to more than 5,600 distressed homes on the market here in Orange County. That's more inventory than we have total today. Today, just 8 distressed homes are available. 8! That's 0.2% of the market. With stricter lending standards, strong equity, and fixed rate mortgages, homeowners are more financially stable than ever. Even if distressed sales rose slightly, it's a return to normal, not a flood. The jobs market is softening more than expected. The latest report showed a rare decline in private payrolls, along with significant downward revisions to past months. The unemployment rate has also ticked up. What does this mean for housing? Jobs drive consumer confidence and directly influence mortgage rates. A weaker labor market signals less economic momentum, which could push rates lower. But if inflation remains sticky, the Fed may still hold rates higher for longer. Mortgage rates dipped below 6.5% in September and have stayed there for over 3 weeks. This is great news. That's already pulled more buyers back into the market. With the latest jobs data showing cracks, rates could edge closer to 6% if inflation trends cooperate. That would be a real boost to affordability and demand. But uncertainty remains. If inflation surprises, rates could stall at current levels. Active inventory dropped 4% in the past 2 weeks to 4,576 homes, the steepest decline of the year. This is the starting of the shift that I've been talking about, I know, for a much longer time than anybody expected. As we move into the holiday season, fewer homes will be listed and more unsold properties will come off the market, driving inventory even lower through year end. Demand rose 1% over the past 2 weeks to 1,609 pending sales, the highest since March. The recent dip in rates is a big factor here, and if rates keep trending lower, expect demand to rise further despite tighter inventory. With fewer homes on the market and more buyers writing offers, expected market time dropped from 90 days to 85 days. That's faster than summer, but slower than last year and right in line with pre-COVID averages. Orange County's housing market is steady and resilient. Homeowners are financially stronger than ever. Foreclosures remain minimal, and the real story this fall is how jobs and mortgage rates shape buyer activity. For sellers, with inventory shrinking, you're gonna face less competition. Serious buyers are still out there, and properly priced, well-marketed homes are in demand. DM me for a complimentary home valuation or to talk strategy, no obligation. For buyers, the softening jobs market increases the chance of lower mortgage rates ahead. That can improve affordability, but it may also bring more competition if rates dip further. Acting now could position you ahead of that shift. Lead the market, don't follow it. I'm Tim Smith. Thank you for joining me for this month's Orange County Housing Market Update. Subscribe to our YouTube channel or our email newsletter to get our update every month.